How do you feel about market risk?
Well, in terms of the volatility of the market, I mean, it's something that definitely has to be approached, and life insurance can be an absolute shield when it comes to the cash value from market losses, and it definitely offers a valuable alternative to market dependent products such as like a 401k because it provides growth and safety, which can lead to a more secure and stress-free retirement. So when you're talking about life insurance, a key advantage of permanent policies like a whole life or an index universal life product, it's the ability to grow that cash while simultaneously protecting that from market volatility. So these types of policies offer the cash value from a growth tied to market indexes such as the S&P, but it's not the direct exposure to the market downturn. So it's the overall performance of that market, not an individual fund out of that market. So this means while your cash value is increasing, while the market performs well, it will not decrease when the market goes down or goes negative. So it's protected from that downside loss. So it has that built-in guaranteed to protect principal. In contrast, the traditional 401k, they're directly linked to the market performance. So as they experience losses during downturns, it can absolutely impact your retirement savings in the future. So from a stability is very important because the stability of these plans as you get closer to retirement, you don't have time to recover from those downturns or losses as you get to that end stage of employment. So life insurance policies with market protection offer a safe haven, not just for cash value, but it continues to grow at a steady rate, regardless of how that market is fluctuating from day to day or week to week. So IUL policies, they even include floors. So what that means it's guaranteeing that minimum rate of return, which typically is a zero, which you'll hear zero is your hero sometimes when it comes to that. So while you might not gain in a bad year, you're definitely not losing that principal. Um, so for those that are risk averse in terms of when you're talking about saving money, a strategy like this provides peace of mind, steady and predictable way to build that wealth while avoiding the stress of the market volatility. So, because of the cash value grows tax deferred, it can be an absolute stable source of retirement income that's less affected by the ups and downs of the market. So, this sharply is in contrast with 401ks, where sudden market drops can lead to substantial losses and potentially delaying your retirement, forcing you to adjust your lifestyle, which I just don't think most people want to do.
Well, it's the tortoise and the hare. I mean, it truly is. It's the idea that during downturns you're going to sit still, um, and your money's not at risk. So, like you said, people who are risk adverse, it makes a huge difference in their options for growing money for retirement.
Yeah, that tortoise and the hare, it's that slow and steady wins the race philosophy, and it's we're talking about that. It's slow and steady, so you may not be getting the massive upswings like some people want to participate in, but you're definitely not participating in the massive downswings, which we have absolutely experienced over the last 15 years or so, a few times. So it's something when you say tortoise and the hare, you hear that. Well, I don't want to be the tortoise. I want to get there as fast as I can because I want to retire earlier, and then these types of mindsets. Well, that's wonderful, but if you're constantly in these battles where you have to make up for lost value, you're trying to now time is now lost in addition to that. And then you lump in the taxable versus tax advantage. These are things that you have to consider. And again, it's what we've talked about before. Will, you and I have talked about this many times. This can't be the only resource. That's not what we're saying here. Layering this, if the 401k is something you're doing, evaluate how you have that structured, evaluate how you're making contributions. Are you, is that set up the way you desire that to be because you want that tax reduction currently because you want that adjusted earned income to be lower? We're not paying as much tax in the current calendar year, but at the same time, do you have a resource or an avenue later in life to where your income can be in a tax advantage state versus all of it being in a tax deferred state where everything has to be as ordinary income tax. So these are just constant things that need to be discussed, not just while you're getting close to retirement age, but throughout your work life.
And I think it's important people understand, when you use the phrase indexed universal life policy, that indexing is huge. Like there's some illustrations and some returns that we've gotten for our clients, or illustrations that we're looking at now with some of the options that are available in these indexes that have huge returns and huge participation rates. And then that's something when you are thinking of the tortoise and the hare, well, starting at zero becomes your hero because the growth potential is huge in a lot of these plans. And I don't think we can mention, market volatility without mentioning the growth aspect as an advantage as well.
Well, just real quick to add to that, when you say zero is your hero, we've said that a couple times here. Um, when you don't have to start over in terms of trying to recapture what has been lost, that's a major advantage. When you're talking about that protection of downside risk, when you don't have to worry about time to get back to what you lost. So when you hear people say, "Well, I lost 10% of my money," let's say, well, then the following year, if I made 10, people automatically mostly think I'm back to where I started. Well, that's not true because you're growing that new 10% off of a new number, not the old number that you lost originally. So you're still below that threshold of where you were to begin with. So to get back to where you started, you don't have to take time to rebuild what you lost first. So when the markets come back up and you're recapturing previous year's losses compared to when I didn't lose because I had that protection and now I'm getting the gain again, I'm continuing to stay ahead of that individual that has to recapture their loss. So that's where that tortoise and the hare really becomes an important story, if you recall any of that from when you were a kid, of how that truly functions, and it really relates to the money.